Morning, guys. This is Tim Melvin of Banking on Profits and the Community Bank Stock Investor coming to you yet again from down here in Central Florida. We're a little bit later in the week than we usually do this. It's just been kind of a crazy week around here. Of course, spent the weekend over at the beach on the coast having just a grand old time there in Melbourne. You don't usually think of Melbourne as a glitzy Florida destination, and it's certainly not South Beach, but there's some fantastic resort style hotels over there, and we found just some simply incredible restaurants, including this week we ate at the Trend Kitchen, which was recently purchased by a lovely couple from France, and the food and wine and everything was just absolutely spectacular. I put it up against pretty much anything in South Beach. It was that good a dinner. So we like going over there. It's real easy shot right down the beach line from Orlando. You can be on the beach with your butt in the sand and a cocktail at hand in about an hour. So we like that. So anyway, just been crazy. A little bit day late here. Read a fantastic article earlier this morning. It was in American Banking, and it was an interview, or actually an op-ed piece, by Stephen Ranzini, who is the CEO of University Bank out in Ann Arbor, Michigan. He noted that when he started in the banking business back in 1988, there were about 20,000 depository institutions, including credit unions in the United States, and call reports back then, that nasty little report you have to file every quarter with the FDIC, they were about 10 pages long. Today, there's about 10,000 total depository institutions, give or take. It's somewhere between 9 and 10, again, including credit unions. And those call reports, they're 100 pages long. Unless you're a real small community bank and you file and the FDIC approves you to use the abbreviated form. That form is fortunately only 80 pages long. The increased cost and effort in preparing of these cost reports, according to Mr. Ranzini, is directly correlated, if not the cause of, that drop in the number of depository institutions. As we've said all along, it's certainly part of the equation. Now, anyway, he used a very simplistic example, but it does help put the costs and the need to grow or sell your bank into perspective. The compliance costs are pretty much fixed. It's going to cost you the same amount to put that call report together, no matter how big your bank is. The information's all the same. It's just how much of it is there. So let's say that the cost for doing one of these reports, or actually doing all the reports during the course of the year, is $100,000. Now, if you have 10,000 transactions in your bank, then your cost is $10 per transaction to do that report. If you have 1 million transactions per year, then your cost per transaction is about 10 cents. You can spread it across a larger asset, larger transaction, larger deposit base. The compliance and regulatory costs become easier to absorb. You have to get bigger, or that fixed cost, that large fixed cost, is going to be there dragging on your income statement, dragging down your return on equity and your return on assets. Now, Mr. Ranzini estimates that by 2025, we are currently down to, in his estimation, between 7,000 and 8,000 depository institutions. He thinks that's going to go to 2,000 banks and 2,000 credit unions left, or just 4,000. Now, right now, there's about, I'm going to say, 6,000 bank and thrifts. So to go to 2,000 by 2025, that is accelerated beyond even my somewhat optimistic projections for bank M&A activity. That'll be fantastic for us as investors. Not so good for community bankers. We're going that way. It's just a matter of how long it takes us to get there. Now, that leads us to a discussion that a subscriber had with me on the site over the last couple of days. And his point of view was, why are we buying these underperforming, lower return on assets, lower return on equity banks and recent thrift conversions that have, lots of capital and lower ROEs, instead of just buying what he thought were higher quality community banks? And he named off a bunch of them that he thought, higher return community banks. Why not just buy those and hang on to them? That's one way of going about it, and we're not opposed to owning the higher performing banks. In fact, if we can get our price, but we're really strict on price. It's going to be 90% of book or less, and we like to buy our initial position right around 85% of tangible book value. We're not very flexible about that either. So if we can get those at our price, and we were 2 or 3 years ago, many of the banks he named as high performing community banks, we actually have owned in the portfolio, and some of them we still own. They haven't been taken over yet. But when you look at community banking world, the lower performing banks are those that are struggling with these fixed and unavoidable costs, like regulatory and compliance issues. And the new one that all the bank CFOs and CEOs are talking about is, of course, technology. Excuse me. You've got to have mobile and digital technology to keep up with the larger banks in the area, or you're going to lose your customer base. Once you have all these wonderful digital offerings in place, you got to spend money on cybersecurity to protect your customers from the bad guys. So that's an ongoing spiraling cost that's not going away. And if you don't have a large enough asset base to spread these costs around, you're going to struggle, and you're going to have lower return on equities, lower return on assets. But now, when banks are looking to buy another bank, one of the biggest factors in the whole thing is, what's the cost takeout? How much cost can I take out of this bank I want to buy? Because if I take those costs out, all that money goes right to the bottom line, and this will be a non-dilutive transaction from day one, as our friend John Allison at Home Bank Shares likes to talk about. So cost takeout is a huge factor. So we're looking to buy these banks that, because of higher technology, higher regulatory costs, have lower returns on equity. Now, what we don't bend on, we insist that they have lots of capital. We're looking for excess capital, high, growing, or at least stable equity to asset ratios, and we don't bend on asset quality. You've got to have a solid loan portfolio, very low non-performing loans, very low non-performing assets, or we're not interested. So the return on assets, return on equity, not really a factor. We're looking at price to book value, no flexibility at all really here. We're going to buy bank at a discount. We want a margin of safety. Okay, we want lots of capital, and we want a very strong loan portfolio. Now, those criteria, when you look at those, they're the same things buyers are looking for. Okay? They're looking to pay a reasonable price. They're not going to get it at the same price that we're going to get it at. They're going to have to pay a premium to book value to get the bank. But they're looking for the higher quality loan portfolios. They're looking to buy excess capital and cut out a lot of costs, so everything that they bring in flows right to the bottom line and adds to their book value from day one. So the lower ROE and ROA candidates, why are we buying them? Because they have two choices, guys. They find a way to grow and scale and deal with those costs, which means their bottom line improves, driving the stock price higher, or they have to sell the bank, and they'll sell it at a premium. And either one of those is good for us. And I'm telling you right now, been doing this for over 2 decades. This is the approach that works best. Now, when you have a huge market sell-off, yes, if you can get those higher quality, higher return on assets, higher return on equity banks at 85, 88% of tangible book value, then buy them. Okay, if you get the serial acquirers like Home Bank Shares, Western Alliance, Bank of the Ozarks, down at a 10 PE multiple, then buy them. But those only come along once in a while. Our bread and butter is finding high quality, safe, smaller banks that are struggling to improve the bottom line because of ongoing fixed and unavoidable costs that are probably going to need to sell. And I will buy a bank at 85% of tangible book and sell it at 125% of tangible book to a buyer all day long. It leads to the type of high returns with actually very low risk if you measure it in just about any way, volatility, beta, financial risk. So we're looking for lower risk, higher returns. This is the recipe that helps us achieve that. That's why our portfolio tends to have many of what you might call lower performing banks. Not really looking at the return on assets, return on equity. We're looking at cost takeout, price to book, equity to assets, and asset quality. That's our recipe. Works extremely well for us. I think we'll stick with it. But anyway, housing starts came out this morning. They fell about 4.7% in September. You got to figure there's some hurricane impact in there, because if you look at the builders' optimism surveys and the recent Fannie Mae Home Purchaser Sentiment Index, everybody's pretty upbeat about the housing market. There's folks that want to buy. There's folks that want to sell. There's realtors that want to help that transaction happen. Builders are pretty optimistic about what they're seeing because there is a short supply of existing homes, creating demand for new home communities. Down here in Central Florida, they do appear to be building on just about every patch of land they can find, but they're selling them. So It's good for bankers. It's good for builders. I think the housing market, I've always said it's going to be a slow, grinding recovery. And I think that's kind of what's going to happen. Now, anytime there's any sort of natural disaster, we get the question, what's that mean for the banks in the area? So in the case of the California wildfires, it's going to be a lot like Houston and in parts of Florida that, particularly South Florida, that were hit by hurricanes. Banks are going to get a lot of insurance payoffs, and there's going to be a lot of demand for new loans. The problem in California, those houses are just gone. Okay, they've taken about a 6,000 to 7,000 home hit to the supply in that area. So I think there's going to be a lot of relocation in the areas that were hit hardest by the fires because there's not going to be enough housing for these folks, and you're not going to be able to build it quick enough to meet the demand. So that's going to be kind of an interesting market. No real long-term implications for the banks in the area. Probably some rebuilding costs in excess of insurance for branches and other assets that were lost. But looking at commercial real estate, really opinion, nothing's changed here. We are seeing a slowdown in appreciation. We're not getting double-digit or even high single-digit gains in property values right now, but they are stable. And most of the properties and most of the markets are showing stable, consistent cash flows. So it's a very good time to be a lender on existing commercial property in most markets. So that's good news for our banks. It means that they can still have those high quality asset ratios that we like to see, and nobody's doing anything stupid. They will. They're bankers. Bankers always reach a little too far for yield at some point in the cycle, but we're not there yet. And I don't even think we're really that close to seeing stupid lending, particularly on the CRE side. Now, we are seeing a lot of banks bump up against those suggested guidelines of commercial real estate to tangible equity capital. And the regulators are looking at it. The banks are aware of it. That could spur a little more M&A activity as banks with larger percentages of commercial real estate look to get down and buy some of these smaller banks, maybe even thrift conversions coming off the 3-year limit that have more of a residential focus in their portfolio to kind of help the commercial ratios look a little better in the regulatory eyes. But stable conditions in commercial real estate. We're pretty satisfied with what we see. We actually think that there's probably some opportunities in senior housing because it looks like the demand growth there is going to be substantial. And most of the companies we looked at in the area recently seem to be reasonably and if not attractively priced. So we're kind of, look, we do stuff besides banks around here. Real estate's been a major focus for a very long time. We do think that senior housing properties might be worth an additional look here. Okay, on the book front, just finished the third offering from the new Newt Gingrich series featuring his character, Major Brooke Grant, and the whole anti-terrorism fight. Now, it's a 3-book series, and it's really good. The surprising thing about Newt Gingrich is whether you liked his politics, hated his politics, he's a really good writer. He's done some historical fiction. He's done just some historical books. And now he's got this new fiction series, and it's pretty good. It's a solid read. I'll put it up there with any of the other Vince Flynn, any of the other kind of anti-terrorist secret agent type of novels. It's a good book. It's a solid read. So whether you like his politics or not, if you're looking for something fun to read, the new Gingrich series is really good. Let's see, almost done with the new John Sanford, which just came out yesterday. Kind of plowed through a lot of it while I was watching the baseball games yesterday afternoon and evening. And looming on the horizon is I have purchased Ron Chernow's new one on Ulysses S. Grant. I'm really looking forward to it. It's about a gajillion pages long, so we'll start disappearing into that, I'm sure, this weekend. So baseball. We couldn't ask for more than this. They've been just great baseball games all the way across. Only the Yankees-Astros the other night was anything even resembling a real blowout. Everybody's been in it right up to the last out of the game. It's why we watch fall baseball. The Fox executives, they're praying, they're sacrificing goats, whatever it takes, because if the trend continues, this could be the first Yankees-Dodgers, Los Angeles and New York, the 2 largest TV markets in the country, be the first Dodgers-Yankees World Series since 1981, and a continuation of one of the greatest rivalries in all of baseball history. Still, personally, hoping the Astros get in there. I'd love to see the Cubs in it, but they're down 3-0, and they're playing the team with the best record in baseball, so doesn't look good for the Cubbies this year. But hey, they won the division, they won the divisional series, they made it back to the championship series, and in recent years, not too many World Series champions have been able to achieve that. So whatever happens, it's been a good year for the Cubbies. So up there in Wrigleyville, you can celebrate. But remember, my daughter lives there. She's 7 months pregnant now, so let's keep it to a minimum. Not too late there. Anyway, that's really about all I've got for you this week. We're looking for another great weekend full of great baseball. We're going to start digging into the Ulysses S. Grant book. The markets are pretty much where they've been. Only real risk is geopolitical. They seem to have shrugged off any real concerns about the Fed balance sheet unwinding. Could come back to bite us later. But so far, just still very complacent markets. They want to go higher. I don't see any reason for them not to go higher here. I don't see any compelling reason for them to go a lot higher, but some folks do. They're buying lots of money going into the index funds. So I don't think we're going to see much changes in the overall stock market conditions in the near term. All right, that's all I've got for you this week. We'll talk to you next week, hopefully back on our regular Monday, Tuesday schedule. We'll see how all that works out. Have a great week, everybody.